The year was 1956. While most 26-year-olds were just launching their careers, Warren Buffett had bigger plans. He was laying the foundation for a fortune that would reach into the billions. And it all started not with a grand windfall, but with just $100 and a deep belief in compound interest. Fresh out of Columbia Business School, Buffett had studied under value investing legend Benjamin Graham. He learned to buy stocks for less than their true worth. But Graham's cautious style didn't suit Buffett's long-term ambition. So in 1956, Buffett formed Buffett Partnership Ltd, raising $105,000 from 7 friends and relatives. He put in only $100 of his own, but offered a rare deal. He'd take 25% of profits above a 6% annual return, but only after investors got their 6% first. The results legendary. From 1957 to 1969, the partnership returned an average of 29.5% annually, while the Dow gained just 7.4%. A $10,000 investment ballooned to $95,000 in 12 years. Buffett's own wealth grew from $140,000 to $25 million. But this was just the beginning. In 1965, Buffett acquired control of Berkshire Hathaway, then a struggling textile company, a move he would later call one of his biggest mistakes. Yet it became his ultimate vehicle for success. Instead of rescuing the dying textile business, he used its cash to buy entire businesses and stock stakes. That 12-a-share company would eventually trade for hundreds of thousands, his masterstroke insurance. In 1967, Buffett bought National Indemnity Company, gaining access to a powerful financial tool, float, the premiums insurance companies collect and invest before paying out claims. By the 1970s, Berkshire controlled over $200 million in float. Buffett was now investing other people's money at no cost. Then came Coca-Cola. In 1988, Buffett shocked Wall Street by investing $1.3 billion in the soda giant, his biggest bet ever. Critics thought it was overpriced. Buffett saw a global brand with predictable profits. That stake would grow to over $11 billion, pushing him into the billionaire ranks. Coca-Cola wasn't his only hit. He turned $10 million in Washington Post stock into over $1 billion, $25 million for See's Candies into hundreds of millions in cash flow. By 1990, Berkshire stock rose from $12 to over $7,000 per share. Buffett's net worth around $3.3 billion. But how did a man from Omaha outpace Wall Street's elite? Not through luck or secrets, through relentless discipline. Rule number 1, never lose money. Rule number 2, never forget rule number 1. He avoided tech stocks during the dot-com boom simply because he didn't understand them. When the bubble burst, his patience saved billions. From 1965 to 2000, Berkshire returned 25.4% annually, more than double the S&P 500's 11.8%. That small difference compounded to massive wealth. $1,000 in Berkshire grew to $4 million. The same in the S&P 500? Just $51,000. This is the power of long-term compounding. Buffett's formula is deceptively simple. Buy wonderful companies at fair prices, hold them forever, reinvest profits, avoid debt, stay within your circle of competence, think like an owner, not a trader. Even as his fortune soared, Buffett stayed grounded. He still lives in the same Omaha house he bought in 1958 for $31,500. He eats at diners, he drives modest cars. Wealth never changed his habits, only his influence. His story proves anyone can build massive wealth, not with genius or luck, but with patience, principles, and discipline. The key isn't timing the market. It's time in the market. Today, Buffett's net worth exceeds $100 billion, but his biggest legacy? Proving that long-term thinking and simple strategies can outperform even the flashiest Wall Street tricks. As Buffett famously said, "Time is the friend of the wonderful business, the enemy of the mediocre."